Whether you're a new investor or an old pro, these ETFs or exchange traded funds are likely already in your portfolio or ones you've been considering, and that's due to the fact that they are some of the better performing ETFs available. Based on that, we'll review the basics about each ETF, including what index they're tracking against, expense ratios and dividend yields of each ETF, the companies they invest in, and any overlap that exists between the funds. We'll also take a look at how each of these ETFs has performed over the last 10 years. And finally, we'll briefly discuss if it makes sense to invest in only one or more of these ETFs at the same time. In regards to performance, here's a little sneak peek of what each ETF would be worth today if you invested $10,000 in them 10 years ago. Which one do you think ended up worth the most? We'll show you a little later which ETF was the winner. Before we dive in, let me know in the comments your favorite ETF or one you're seriously considering and why. Also, press the like and subscribe button so those YouTube algorithm experts know they got it right showing you this video. First up, SCHD, which is Schwab's U.S. Dividend Equity ETF, which tracks against the Dow Jones U.S. Dividend 100 Index. SCHD currently has an expense ratio of 0.06% and a very nice dividend yield of 3.43%. Out of the three, it has the largest dividend yield, which makes sense since the index tracks against 100 dividend-paying companies. Wait, did I just say since 2 times in a row? Let's roll that back and see. Which makes sense since the index... Well, I sure did. Anyway, many people like having SCHD in their portfolio because of that nice dividend. As far as investments, here are the top 10 companies the fund currently invests in, and those top 10 account for almost 41% of the fund's investments. The top 5 sectors for SCHD are financials, healthcare, consumer staples, industrials, and energy. SCHD has over $54 billion in assets, which makes it around the 30th largest ETF in relation to total assets. QQQ is Invesco's Trust Series 1 ETF, which tracks against the NASDAQ 100 Index and currently has an expense ratio of 0.20% and a dividend yield of 0.60%. As far as investments, you'll see QQQ is heavily invested in technology with almost 60% of the fund invested in that sector. Here are the top 10 companies the fund currently invests in, and the top 5 sectors for QQQ are technology, like we already discussed, consumer discretionary, healthcare, industrials, and telecommunications. QQQ has over $258 billion in assets and is currently the 5th largest ETF in relation to total assets. Finally, VOO is Vanguard's S&P 500 ETF, which tracks against, you guessed it, the S&P 500 Index. VOO currently has a great expense ratio of only 0.03% and a dividend yield of 1.35%. Here are the top 10 companies that VOO currently invests in, which make up just over 31% of the fund's investments. The top 5 sectors for VOO are information technology, financials, healthcare, consumer discretionary, and communication services. VOO has over $430 billion in assets and is currently the 3rd largest ETF in relation to total assets. Maybe you're wondering which ETFs are bigger than VOO. Well, that would be Spider's SPY and iShares IVV, which both also track the S&P 500 Index. Now that we've gone over a quick summary of each of the funds, let's review an area that's often overlooked when investing in ETFs, and that would be ETF overlap. If you're wondering what ETF overlap is, it's probably easiest to show you with a few examples. In our first example, we'll compare the real estate ETF named REIT with SCHD. As you can see, they have a 0% overlap because they aren't invested in any of the same assets. But on the other hand, in another example, if we compare VOO with SPY, you'll see that those two ETFs overlap 98%. So what does this all mean? Basically, VOO and SPY are investing in the same assets, while our earlier example of REIT and SCHD have no overlap, so they aren't investing in any of the same assets. If you plan on investing in more than one ETF, then you'll likely wouldn't want to invest in ETFs that have a high percentage of overlap. For the 3 ETFs we're reviewing when looking at SCHD and the overlap it has with QQQ and VOO, it's very low. As you can see here, SCHD only has a 6% overlap with QQQ and an 8% overlap with VOO. This would make SCHD a very good candidate to pair with QQQ or VOO based on there being very little overlap between them. Now, what does the overlap look like when comparing QQQ and VOO? As you can see, it's much higher than what we saw with SCHD. Currently, the overlap is at 45% when measured by the weighted allocation in each fund. Currently, 85 of the 100 companies that QQQ invests in are also in VOO, while 86 of the 510 companies, or 17% or so, that VOO invests in are also in QQQ. With a 45% overlap, does it make sense to invest in both QQQ and VOO at the same time? In general, no, since the main goal of an ETF is to offer diversification, and having two funds with that much overlap could get you too oversaturated in certain sectors and cancel out the main reason we invest in many ETFs, diversification. Okay, now back to the topic that many want to see, and that is the performance of SCHD, QQQ, and VOO. Earlier in the video, we showed you the graph of the three ETFs and what they would be worth if you invested $10,000 in each fund 10 years ago. Which one did you think ended up with the highest value? SCHD with that nice dividend each quarter for over 10 years? Or maybe VOO since it tracks the beloved S&P 500 index, which has historically done so well? Or could it be QQQ since it's so heavily invested in technology? Well, it ended up being QQQ and by a pretty wide margin. That $10,000 invested in QQQ would be worth just over $55,000, while VOO comes in valued at a little over $33,000, and finally SCHD ended up just under $29,000. That's a pretty significant difference, and the QQQ grew an additional $22,000 over VOO and $26,000 over SCHD, proving it was the clear winner over the last 10 years. But if you follow investing on social media, you've likely heard the term just VOO and chill, meaning just put your investment in VOO and don't worry about investing elsewhere. I'd say based on the last 10 years, it should just be QQQ and chill, chill, chill. But in all seriousness, for many new investors, there's absolutely nothing wrong investing most of your money in an ETF like VOO or others that track the S&P 500 based on a lifetime average around 10% return per year. QQQ just happens to perform better, and I would expect it would continue to outperform VOO and other S&P 500 tracking ETFs due to the heavy investing in technology and companies that are at the forefront of AI development. Finally, let's discuss if it makes sense to invest in only one of these ETFs or two or all three at the same time. As you saw earlier, SCHD has very little investment overlap with QQQ and VOO. So I wouldn't have any issues with having a portfolio that invested in SCHD and one of the other two. I wouldn't recommend investing in all three at the same time based on the fact that there's a significant amount of overlap between QQQ and VOO. You could make the case for that VOO and chill suggestion since we know that the S&P 500 is a very solid long-term investment to follow. But my recommendation would be to pair up QQQ with SCHD based on the very little overlap between the two, and really because QQQ outperformed VOO by a very significant margin over the past 10 years, and with QQQ being heavily invested in technology companies that are or will be leaders with AI, I think it will continue to have significant return advantages over VOO or any of the other S&P 500 tracking ETFs in the foreseeable future. Well, that's it for this video. We reviewed three major players in the world of ETFs and discussed each fund's investment focus, return, expenses, and yields, and saw how each of the funds overlapped in their investments. Let me know in the comments your thoughts on these three ETFs and if you're invested in them. As always, thanks for watching and hanging around till the end. Don't forget to like the video and subscribe so you know when I put out new content focused on your money and how to manage it best with a little bit of comedy thrown in for good measure. See you next time.